Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and kicking off this week's episode with the macro debrief. So a few data points surrounding inflation came in this week. We saw CPI come in at 2.7% versus a consensus estimate of 2.6% year over year. Core CPI was 2.9% versus an expected 3.0% year over year. And PPI came in as well. That was pretty much flat, 0.0% versus the estimated 0.2% month over month. So, with regards to CPI, we've basically seen an uptick in inflation, right, from last month. And I think it's important to understand that maybe the implications of the tariffs are starting to kick in. If we look at the labor market, that seems to be doing okay. Nothing crazy noteworthy this week. Continuing jobless claims were slightly lower than what was expected. Same with initial jobless claims. Don't want to get into that too much. But another bit of macro news that came in was retail sales, right? And this was a good surprise in the positive direction. It came in at 0.6% versus an expected 0.1% month over month, right? If we look at retail control, which excludes your sales of food services, auto dealers, building materials, and gasoline stations, it was at 0.5% versus an expected 0.3% consensus month over month. So pretty much, some pretty strong retail numbers here, right? As I said earlier, we're starting to see that tariff impact on inflation, kicking it up closer to 3%, that 3% that I spoke about before. And I suspect that trend is going to continue, right, as we go on further this year. Retail sales surprisingly strong, though, for the last quarter month. And even the control group is stronger than what many expected and what I expected personally. And my suspicion is twofold as to why this is. Either that since we saw an uptick in consumer sentiment, people got more comfortable with the deal news coming in on tariffs and Trump cutting deals with companies and started to buy things, or people want to front run and buy things before August 1st because they suspect that prices of products are going to continue to go up because deals may not be made. Regardless, the current retail sales number is good news, but it's to be taken within context, right? I do expect to see more of that inflation rise as we move on later into the year. And I actually think retail sales are going to be reactive to that piece of information, right? If the labor market starts to weaken even further and unemployment starts to tick up, then we know consumer sentiment is going to go down and we can expect to see a big drop in retail sales. But I think for this previous quarter, for this previous month, it's a pretty strong reading. And yeah, I think it's something to keep in mind, I guess, as we move into this earnings season. Now, we also know that this last week earnings season kicked off, right? And first thing I wanted to do was take a look at some of the banks and financials that reported. So I don't want to go into each and every bank that reported or each and every major bank, but I'll kind of summarize, I guess, some of the key takeaways that I got reading a lot of their earnings reports and transcripts. So most financial institutions posted year-over-year gains, right, in terms of revenue. But the pace of those gains are decelerating compared to 2024. Now, net interest income remains a key profit driver. For example, Bank of America's net interest income hit a record of $14.8 billion, which was up 7% year over year. I think another trend that I saw was that trading revenue remained pretty solid. We saw that with Goldman, very strong, which makes sense given the all-time high in the market, right? People are active, people are buying. And speaking of Goldman, Goldman and Citi reported strong double-digit increases in their investment banking fees, which was driven by a rebound in M&A and capital markets activity. So, people are more optimistic about the market. Consolidation's happening in certain industries. Deals are happening. Companies are getting busy. Another thing I noticed was around consumer credit, right? I wanted to assess kind of what I could take away with regards to the state of the consumer from these banks' earnings. And by the looks of it, consumer credit metrics remain pretty healthy, right? But commercial real estate, especially offices, is starting to emerge as a growing source of charge-offs and provisions. So, this kind of ties into that retail sales number, right? Consumer credit, consumer strength is not really suffering, and the economy seems a lot more resilient than maybe people thought it would be, and definitely more resilient than I thought it would be at this point. So it will be interesting to see how some of these other retail companies report their numbers this earnings, and I think there could be a lot of opportunities for a positive surprise for a lot of these companies that operate in the consumer discretionary space. The last takeaway I saw was that most financial firms highlighted cost control, right? Bank of America, JP Morgan both reported lower than expected expenses, and that's going to be a theme going forward. With AI operational efficiency, people are going to want to lower that expense, lower the costs, and be more tight on their budget. Now, with regards to financials as a whole, right? If the belief is that interest rates are going to come down, then the main headwind would be anticipated slowdown in net interest income growth, right? That would be the main headwind that banks face. And this is strictly if you believe that interest rates are going to come down, which is a big if, right? That there's a big question mark around that. Where is inflation going? Do we, these are all questions that need to be answered in one's mind. As I said, consumer spending and credit quality seems to be very resilient. Now, the banks, obviously, a lot of the CEOs, move forward with guidance with respect to cautious optimism, and that seems to have been the theme within the bank's earnings. So, I think it remains true that diversified banks will remain the best positioned. The banks that operate in multiple aspects of the financial industry, the banking industry, whether it's corporate banking, retail banking, wealth management, or investment banking. So, I think a company like JP Morgan obviously remains the best positioned, but it's also trading at a premium that suggests so. So, I think with banks, it's always interesting to kind of do a wrap on what their outlook is for the coming quarter or 2 quarters, and in our case, the remainder of the year, and also figure out kind of how the consumers are doing before we dig deeper into earnings season. Now, moving on to some other earnings that happened this week, I think there are 3 more I want to talk about, 2 that revolve around the semiconductor industry. I'm sure you guys can guess which companies that is, ASML being the first one, right? This is one of the most important companies in the supply chain of the semiconductor industry. Now, they reported earlier this week, shares of the company dropped more than 10% after results. So let's take a look at why. Net sales came in at 7.7 billion euros versus 7.52 billion euros, which was expected. Net profit was actually higher than expected as well, 2.29 billion euros versus 2.04 billion euros, right? So this was a beat on both the top and bottom line, with tariffs supposedly having a less negative impact than expected, according to CFO Roger Dassin. So everything seemingly being positive with regards to their result. It was a classic beat. So what actually drew the stock down? I'm sure you would have guessed, guidance. For 2026, the company warned the possibility of no growth, right? And this was primarily driven by uncertainty in tariff policy and macroeconomic uncertainty as well. So, macroeconomics aside, there seems to be structural growth in the space. And, companies seem like they're continuing to spend on CapEx, right? Machines that ASML produce are likely going to be needed more and more if this trend continues. So while I think, yes, short-term volatility may exist for a company like ASML because of macroeconomic uncertainty, the company almost has a monopoly, right? So the long-term sustainability of this company seems to be in solid shape. I don't think there's any denying the importance that ASML plays in the semiconductor ecosystem, and I think that management in guiding flat revenue growth may just be overly cautious here, and I think this could very well be an opportunity for investors to get in at current levels, and then see that maybe in a year's time the ASML stock has done so well because the company has continued to grow at rates that investors were not pricing in after this week. Now, another company that reported earnings, staying on the topic of semiconductors, was TSMC. Again, an extremely important company in the ecosystem, right? They reported earnings this previous week too. And it seems like each quarter we repeat the same things, right? When it comes to companies like TSMC, NVIDIA, it just seems like AI chip demand has been the main driver of growth here, right? That's the theme for TSMC's quarter. Their revenue was about 934 billion new Taiwan dollars versus an expected 931.24 billion. Net income was 398.27 billion new Taiwan dollars versus an expected 377.86 billion, up 61% year over year. So a solid beat on estimates. Now, the high performance computing division, which accounts for 60% of their revenue, was the primary driver in strong results. And this refers to your AI chips. So, much like ASML, TSM are subject to tariffs here, and a deal has not yet been made with Taiwan. So that remains a key risk. However, CEO C.C. Wei mentioned that despite these risks, they have not yet seen any change in customer behavior, which is showing the resilience or even neglect towards the tariff policy, right? Companies or businesses are going to continue to do business. And TSMC is expanding its global manufacturing footprint. They're making major investments in the US, Japan, Europe, Taiwan, and their capex for 2025 remains at 38 to 42 billion US dollars, right? With future increases possible depending on demand and macro conditions. So I think with these plans on the horizon and the kind of earnings that we've seen, the AI chip the AI chip demand is truly very, very, very high in demand. And going into this earnings season, I think it would be interesting to hear from companies like AMD and Intel. And I think a lot of that is going to shape our view on TSMC and how they're going to progress going forward, right? Seemingly the strong results from both ASML and TSMC point towards ASML actually providing a more decent entry point for investors. If I had to pick between the two, I'd actually pick ASML at this point, right? If demand is so strong, if demand is as strong as both these companies say, I think regardless of tariffs, different companies will want to win this AI or AGI race. And if in order to do that, they have to spend, then so be it in their mind. I don't see Zuckerberg slowing down and spending 200 million to get one guy on his super intelligence team, right? So what's another 50-60 billion in that case, right, in terms of capex? So I think we're going to see ruthless expenditure from big tech or even other smaller tech companies, and people are going to want to get in on this hype before it becomes out of reach for them. Now, of course, I think over the last year and a half or so, the talk has been constantly around AI, right? So valuations in general can be a little stretched, and I'm not saying in any way like that these are value plays and ASML's a complete value play, but I think AI does provide a huge opportunity, and I think it's worth noting that despite this huge opportunity, valuations are very stretched for several companies, right? But it's about identifying the companies that maybe are not fairly priced in terms of what they can potentially offer with regards to how big this AI market and opportunity can be. Now, the last company I wanted to talk about was Netflix. Netflix reported earnings earlier this week. Now, before I get into their earnings, I do want to say that Netflix has as a company, easily steamrolled ahead of peers when it comes to streaming, right? There's no argument that Netflix have won the streaming wars, if that can be said, right? While content can be argued on a subjective basis as to whether one likes it or not, objectively, the user growth, the retention, the geographical expansion, breaking in their ad tier and expanding into live streaming, Netflix have done almost everything right. And their earnings this year was no different to this trend. A solid beat for the quarter. EPS came in at $7.19 versus $7.08 according to LSEG. Revenue came in at $11.08 billion versus $11.07 billion, up 16% year over year. Now, the strong top-line growth was primarily a function of more members, higher pricing, and increased ad revenue. Along with that, I think Netflix raised its full-year reported operating margin guidance from 29% to 30%, reflecting a stronger than expected member growth in ad sales, right? With ad revenue actually on pace to double year over year. Content expenses are expected to ramp in Q3 and Q4 simply due to a strong slate of new titles and live events, and also returning titles like Happy Gilmore 2, but operating margins are still projected to be up year over year in each quarter, including the fourth quarter. Now, Netflix's rollout of their proprietary ad tech stack, right, Netflix Ad Suite, is now done globally, and early results have met or exceeded expectations for them. Advertisers seem to be attracted by the growing scale, and new features like improved targeting are helping to attract these advertisers as well. And interactivity, actually, that was something that was mentioned, would be coming in the second half of the year. Now, of course, Netflix has done exceptionally well, and so has the stock, right? It's hard to say that Netflix is undervalued at the moment, and while they have been obvious leaders and winners thus far in the streaming space, I think it's worth paying attention to the likes of some of the other players, and I say this thinking namely about Warner Brothers Discovery. After the release of Superman, the stock has been up almost 10%. Apparently the movie is good. I'm yet to watch it, so I don't want to comment too much. But I know that James Gunn has taken over the DC universe. And, what kind of occurs in my head is, will DC provide the same value to Warner Brothers Discovery that Marvel did to Disney, right? Marvel's loss could be Disney's opportunity here. And aside from DC and the DC universe and that IP, I truly believe that HBO Max has a better suite of shows and movies than Netflix. While Netflix may be a gold standard for many households, I think the content you find on HBO Max would actually provide a longer sustained moat in the space. I just think for a company like Warner Brothers Discovery, it's more about figuring out how to deal with the other networks and legacy media channels and how to kind of package and, I guess, blend everything in economically and financially. Now, on that note, that kind of wraps it up for today's episode. As usual, anything I say is not formal investment advice. It's purely my opinion, and it's for informational and educational purposes only. If I sounded a little tired on today's episode, I do apologize. I have been traveling, so it's been a pretty hectic week. But with that, I thank you for listening. I'm Anurag Birla, and this is the Finance Now Podcast.